We invested $500,000 for one of our most risk-averse clients, and that investment now pays him just over $7,400 every single month. It's enough to cover his entire cost of living. But here's the part that surprised him the most. This wasn't a high-stakes gamble or wild investment. It was a deliberately structured investment that we created for him with real downside protection built in. So in this video, I'm going to walk you through exactly how we did it, why it worked so well for his particular situation, and how you might be missing out on investment options you didn't know existed, such as this one. Before I get into his specific situation, you need to understand one fundamental idea that many people get wrong. And that's building wealth and living off wealth are two completely different skills. Most people know the first one: save, invest, grow your pile. That's the growth phase, and we do help a lot of clients do this really well. But there is a second skill that people don't talk about as much, which is taking that pile you've built and turning it into reliable income that you can actually live on. That's the income phase, or some people call it the decumulation phase. It's where most people are completely lost and where we help a lot of our clients as well. They spend 30 years learning how to grow their money, and then they hit retirement with no idea of how to make it pay them without directly pulling down out of their investments. But there are more ways to generate that income than most people realize. Some people park their money in CDs or high yield savings bonds or bond funds that can do a little bit better in terms of interest. Dividend stocks and enhanced dividend funds are other good options. And then there's annuities, which can offer guaranteed returns, unlike some of those others. There's also one that most people haven't heard of, and that is an income structured note, which is what we specialize in and what we used with this client. So let me show you how this all played out for our new client and how you can learn from it too. If you're a working professional and want to know exactly where you stand in terms of your retirement prospects, you can use our free retirement readiness assessment tool to get a comprehensive overview. You just plug in your numbers and it'll show you whether you're on track for the retirement you want and changes that you may need to make to help you get there. It's completely free. The link is in the description. So this client came to us in his 50s. He made good money in his tech career. He saved diligently. He had invested well enough on his own. He lived comfortably, not extravagantly. And by the time we had met him, he had about $1 million ready to invest, but was still planning to work for several years. He wanted two things that usually pull against each other. He wanted solid returns, but he was also quite risk averse. He wanted growth, but he didn't want to watch his life savings get cut in half if the market had a bad year. So an average return of about 10% was his goal. So after some consideration, we decided to split his money in half. 50% went into growth assets to keep compounding for the future, and 50% went into an income solution that we designed specifically around his fear of a downturn. So here's that solution. Here's what we built for that $500,000 investment. Because he was risk averse, we wanted real downside protection in case the market fell. So we designed a structured note and then priced it out with several investment banks to see who would do it and who would give us the best interest rate. The result for him, he locked in a 17.9% annual yield paid to him monthly as long as 3 major stock indexes don't fall by more than 20%. On his $500,000 invested, that works out to just over $7,400 a month in income as long as those indexes don't fall materially. He was blown away. Just by structuring half his money this way, he could cover his entire cost of living without selling a single asset and while keeping a protective barrier underneath him. Now, a structured note is a term that a lot of people haven't heard of. So let me explain what that actually is. A structured note is a customized investment built with an investment bank designed to do a specific job. At Mountain Goat Wealth Management, we want to help our clients generate income while still protecting themselves during uncertain market conditions. Income structured notes are helpful tools that we use to do this when working with qualified investors. Since we are an independent firm, an RIA, we have the ability to go directly to specific investment banks and customize these notes for our client specific goals. In this case, the job was high monthly income with a barrier against moderate market drops. So here's how this client's note worked in plain terms. His note was tied to three major stock market indexes: the S&P 500, the NASDAQ 100, and the Russell 2000. His income depended on the weakest of how those three performed. On the income side, as long as the lowest performing of those three indexes stayed within 20% of where it started, he got his full monthly interest payment. If some month the lowest income index dropped below that 20% starting point, he simply wouldn't receive interest just for that particular month. It would pick back up when the market recovered. Then there's the principal, which is his original $500,000 of capital. This note had a 2-year term. At the end, as long as the lowest index had not fallen more than 25% from its starting point, then he gets 100% of his capital back. So the index could be down 10%, 20%, or flat, and his full investment, his full $500,000 would come back to him untouched. So these aren't for everyone and aren't for every dollar you have. In the worst case, if that had dropped by more than 25% and the barrier was broken, the client would absorb the losses. So if he were down 30%, he would only get back 70% of his capital. And because this note is issued by a bank, the entire arrangement depends on that bank staying solvent. If the issuing bank fails, the investment can be at risk. So, like I said, that was only half of his initial $1 million investment. So what happened with the other half? Well, that side stayed invested for growth. And for the record, that's been doing well also. But that really isn't the point of this video. The main takeaway is that he can now live entirely off of the income side, covering all of his expenses, while the growth side keeps compounding in the background. That growth money can fuel his future: big purchases, charitable giving, something to pass on to his family. His savings are paying him and still growing at the same time. So if you're sitting on a portfolio that you've worked hard to build, you want to know exactly what kind of income you could get from it realistically, let us know. We'll talk through your actual situation. We'll see what next steps could best help you achieve your financial goals. That link is in the description. So what can you practically take away from this client example? 2 things. Creative investment solutions genuinely exist. The trick is fitting them to your actual goals and not just picking products off the shelf. Second, and more important, is that retirement might be closer than you think. If your capital can be arranged to produce enough income to comfortably cover your lifestyle, then ask yourself honestly, what's stopping you from retiring? That's the question we love helping people answer. There's a fair chance that if you're watching this, you might be closer to a comfortable retirement than you think. And if you think that's you, watch this next video where we break down the one number that lets you know if you're ready to retire early.